Stocks recover last week as Europe stabilizes on hopes of energy ministers capping prices and offering support packages. The dollar pulls back, taking risk assets higher ahead of key CPI data, and metals stage a bounce from oversold conditions. All this and more in this week's Macro Insight. Okay, welcome back to Macro Insight, everyone. Today is the 13th of September, and let's have a look at these markets. So stocks recovered last week as Europe stabilized on hopes of EU energy ministers providing support with price caps on energy, effectively fiscal support, as businesses and consumers were feeling the pinch of the ridiculous price spikes in gas and electricity. S&P also squeezed higher as positioning seemed to get a bit too bearish again, and you kind of see this happen a lot this year where everyone gets one side of the boat and then the pain trade kicks in. So, ahead of CPI today and FOMC, looks like people were leaning a bit too short last week and they needed to be squeezed, and that's kind of what happened. US rates stabilized near the kind of recent highs. Obviously, they've continued to tick higher just now. So 75 basis points for the FOMC meeting next week was priced at 92% probability before this CPI print just came out. We also had, we had hawkish Fed speak, kind of helped drive that probability higher and higher over the last few weeks. RBA hiked 50 bips. Bank of Canada hiked 75 bips, and ECB hiked 75 bips last week. So we're starting to see all central banks really on the inflation fight. So, that move in the ECB took German two-year yields up about 22 basis points last week, outpacing other rates markets. And you can see in the chart down here, it kind of shows you month-on-month changes and week-on-week changes. And basically just seeing the German two-year was kind of leading the way in terms of week-on-week moves. And it gives you some context of the type of moves we've seen on the month, where UK two-year is up 113, similar to the UK 10-year. So those rates have really been flying. And then Germany, 2s and 10s, both up similar, around 75 bips a piece. Yeah. The dollar retreated from very overbought levels last week, helped by the Bank of Japan mentioning potential intervention as the dollar yen approached 145. And the euro bounced as well on the more hawkish ECB. And the idea that, some of this fiscal support in Europe will kind of help calm and just kind of help that economy, buy them a bit more time, basically, to deal with this energy crisis. Commodities bounced, obviously, as the dollar pulled back. Metals leading the way. So you had silver and palladium flying. There you go, copper, iron ore, silver on the map there with, above 1 sigma moves. You've also got energy that was lagging though, right? So energy, as you can see, was slightly down, right? Nat gas was down as well. Oil and uranium kind of flattish on the week. Credit spreads tightened on the relief rally and risks. You can see US high yield CDS getting slammed close to 2 sigma. And then crypto is the black bars here, crypto rallying, led by Bitcoin for a change, with the merge due in the next few days. Likely some position squaring going on before the event, covering some of those Bitcoin shorts that everyone's been using to fund that long ETH trade. So closing those out and really seeing Bitcoin fly to the upside, which we haven't seen in quite some time. All right, so that was the summary. In terms of what's coming up this week. So we just had CPI, looks like a big beat. Core was expected at up 0.3 and we got up 0.6. So that's going to spook people. That's going to spook the rates market. And that's certainly going to see yields probably trade firm, if anything. We'll see how equities digests it. Equities had been rallying quite strongly, likely just sort of on positioning and CTAs being forced back in and all that sort of technical nonsense. But now we've got a real fundamental reason to not like the market again. Let's see how equities reacts. Otherwise, we've got retail sales on Thursday in the US. We've got preliminary University of Michigan sentiment numbers on Friday. And in terms of the outlook sort of going forward over the next, well, for the rest of the month and kind of even into, later in the year, we've got this Shanghai Cooperation Organization, basically a Putin and Xi meeting at the end of this week. So that might kind of flare things up on the geopolitics. We've got the FOMC obviously next week. We've got Bank of England meeting that was postponed. That's coming in on the 22nd of September. Also SNB meeting as well, same day. Italian elections on the 25th of September to look out for. So, you know, the euro is going to probably react to that to some extent. And then obviously November the 8th, we've got the US midterm elections. So those are the big sort of events that are on the radar going forward. All right, now let's just take a look at what's been happening. So, you know, we had that sell-off sort of early last week where the market kind of made a bit of an interim bottom. We saw very big outflows out of tech from Bank of America's research. So you see here, largest outflow in tech since January 19, pretty punchy. Also, we were seeing European outflows massive. So you can see highlighted in that red ellipse there, that's, you know, 4-week moving average, well below those levels for quite a long period of time. So European outflows, you know, getting quite large. And that kind of explains a little bit as to why we've had such a sharp snapback in Europe, because everyone's just been panic selling out of it. CTAs that we had said, you know, we're going to turn sellers if the market turns south. It looks like they did. So here we've got data from Goldmans showing, you know, the kind of change in CTA positioning, and that was a pretty dramatic collapse, right, in CTA positioning. So CTA is really getting chopped around quite badly in these quite wild market swings, right? So if we do continue rallying, CTAs are going to be forced buyers again. So they're going to get chopped again on the upside. But, you know, now this fundamental data has come in, maybe that calms down and they don't need to chase this market back up like they have been doing, it seems, in the last few days. Yeah. But yeah, they've definitely been a big driver of this movement. If we then look at other evidence of the squeeze last week, we've got GS most shorted basket ripping 8% last week. So from the 6th to the 12th, you know, that's outperforming. Generally, when the most shorted basket outperforms, it kind of gives you that indication that, yeah, this is a short squeeze that's driving things. It's not really driven by a fundamental bullish reason. It's just more shorts getting hurt. That being said, you know, there was potential, if that CPI had come in light, there was potential for us to continue squeezing above 4,200. But I think that scenario is probably dead in the water now with this data point, given that it is quite dramatically different from expectations. Now, Charlie McGilligan the guy from Nomura, was looking at his data where he kind of tries to identify the inflection points for CTAs and where they're going to need to chase the market and where their signals are going to flip and stuff like that. So they had seen a flip at around 4107 on the S&P. That if we broke above that like we did yesterday, that was going to induce more CTA buying. We did get an overshoot up to like 4140 odd, but now obviously that's faded again. Okay. Me personally, I've been running a much tighter book at these levels. I felt that the risks appeared quite balanced going into this CPI. Whilst we could continue to squeeze higher, we could easily just fade, especially if the data warranted it. And that seems to be what's happening. Okay. But it's early days, right? Literally, the data just came out. We did have a quick drop. We are down best part of 2% on the S&P as a reaction to it. Let's see if the market can find some stability. And we'll talk a bit about the option positioning that might kind of lend itself to that support over the next week or two. Okay. Okay, so the next thing to talk about is sort of S&P price action. We look at this sort of more longer term chart. Obviously, from that bottom down near 3,900, which seemed to be quite a strong support zone, we did recover and we got pretty damn close to that final retracement level at 41.55. Okay, like I said, I thought there was a potential for us to push up to that 200-day again if the news flow helped, but it clearly hasn't helped. So that scenario is, like I said, not really looking very likely. So that's kind of what the longer term chart has looked like. In terms of the shorter term, yeah, so here you can see, so, you know, since we sort of broke above that 4,000 level, it's been quite an orderly ascent, right? And this is something that Brent at Spot Gamma has been talking about. So whilst he hasn't seen the call wall shift higher in S&P, because the call wall is just kind of stuck at 4,005, because that's the biggest call position and it's not going anywhere until the end of the month, basically, right? So it seems like the call wall in S&P is just going to be stuck there because that's such an enormous position, the JP Morgan collar call that everyone's long. So that's going to leave the call wall on the S&P there, but you had seen a shift higher in the call wall on the SPY. So that had gone from 400, which is equivalent of 4,000, up to 4,100 or 410. Okay, so you had seen a shift higher in that, suggesting that positioning in SPY was moving up and kind of confirming the bullishness. Okay, but we know the street is very long these options in the 4005 area. Okay, so my sort of thought was that the dealers are likely to be long gamma in this whole region between 4,000 and 4,100. That's probably a place where dealers are long. So I wouldn't expect, you know, too much volatility. I wouldn't expect implieds to really explode if dealers are long that stuff. Okay, and the price action involved last week suggested dealers are long because they were selling that volatility, and as they were selling that volatility, we know what tends to happen. All these puts that they were short down here, where the put wall shows you 3,700 as a max short, 39 or 3850 area for SPY, all those puts were getting evaporated as volatility comes down, and that then triggers the Vanna rally that makes people cover futures. And that is what we're seeing. This orderly move up in spot as vol gets compressed was being supported by that Vanna positioning, basically, right? So that kind of made sense, and that kind of fit what we were thinking, you know, along the lines of positioning. Now, obviously, all those puts down there that got evaporated, pretty low premium now. If the market starts to come down and breaks 4,000, those puts can then ratchet back up in value again and create some volatility, right? So there is that. But because we aren't really breaking, we haven't broken 4,000 yet, and we know the street is very long the 4,000 area, I would suspect that's going to provide some level of support. Okay, so one to watch. I mean, if it breaks down, then obviously that can change, but I suspect that it's going to find some stickiness around that region. Okay. Now, I was hoping the market was going to push on and get above 4150, because my plan was to start sort of reloading on some hedges. I took quite a lot of shorts off around 3,900. So I'm pretty light on sort of equity hedges right now. I'm not massively invested anyway, but in general, I was pretty light on my shorts. I kept some HYG shorts via those puts that I had, but equities I was looking to reload if we got a little push higher. Unfortunately, we haven't had that. So I'm going to have to kind of reevaluate. If we were to break down below 4,000, then I'd maybe look to just kind of add shorts, because that support level has given way and we still could have a lot more downside. Yeah. Okay. If we then move to, and like I say, you know, I think once CPI is now out the way, once FOMC is out the way, if we're still hanging around that 4,000 area, then going into the end of the month, that JP Morgan position is going to start to explode in the amount of gamma that it's got. And it's going to make it quite hard for the market to really break away from that. Yeah. So we seem to be headed in that direction. So, you know, what comes from the FOMC, I mean, it's probably nailed on now that they're going to do 75 bips. This data point wouldn't have changed that. I don't think it's going to make them do 100 bips next week. So that just confirms what they're going to do. So then maybe the market does find itself in and around that 4,000 area post FOMC, and dealers could get stuck with that long gamma that they're choking on. Yeah. All right, if we then go to sort of sectors, what's been going on in the sectors last week? Pretty broad-based rally. Retail and consumer stocks leading the way, 8%. You had financials and tech not far behind. Metals and mining as well, up around 5 to 6%. And then the laggards were your staples, your utilities. That, you know, makes sense, right? The defensive kind of lagging as we were getting a bit more of that reflation type price action out of markets. Yeah. Global stocks, if we look at those, you know, you had US leading the way, Russell, NASDAQ, S&P, the leaders, up 5%-ish, but Europe wasn't far behind, at about 4.5%, which, you know, market was starting to kind of price in that the worst was behind us in Europe in terms of the energy crisis news flow. You know, Russia have turned it off now. There's not much else that they can do, right? And then obviously with the fiscal support packages being talked about and discussed, that kind of made markets feel like Europe kind of was as bombed out as it was going to be. And then we started to see a bit of a relief rally. And that was signaled by European SKEW that started to fall last week, as we had flagged. And that, you know, often you get that, right? When SKEW was quite elevated, pricing in the bad news that was coming, and then the bad news comes, and then SKEW reprices lower, kind of tells you what the market's thinking, right? Kind of showing its hand that a relief rally was likely. And we got that out of Europe. China continues to lag, as you can see, FXI, with their ongoing COVID issues and lockdowns and stuff. I mean, it's just, you know, that saga continues basically. So we've got the sigma adjusted moves. You can see obviously equities having strong sigma adjusted moves. There's where the implied volatilities are coming down. So 1.5 sort of sigma rallies in US and Europe. You would expect implied vols to come lower on that as it follows the skew. We know that the skew automatically prices vol lower because we're rallying to higher strikes. As we rally to higher strikes, up about 5% on the week, you would expect the implied vol to be lower because the at-the-money vol moves from those lower strikes to the higher strikes, okay? So we saw that. We saw about 1.7% down in at-the-money S&P, 1 month vol, and nearly 3 vols down in Europe. So decent move lower in implieds. Positive carry that we had seen in Europe got eviscerated. You know, the markets were obviously charging higher on a much higher realized vol. You had realized that about 25.5 on a 10-day now in Europe. US realized has been more orderly though. So realized at 18 relative to 21.5 on implieds. So you had about 18% carry available in selling US gamma, no money to make in selling European gamma. And then China's pretty much equal to its implied. So kind of fairly priced, right? The gamma in China. Term structures, if we look at kind of, you know, what the term structure looks like, we can go to S&P here. Term structure on S&P is pretty flat. And you'd expect that ahead of these like very short-term catalysts like CPI and FOMC, right? So even though the realized isn't that great, normally when realized is quite low relative to implied, you've got this upward sloping curve, which we call contango. But when you've got an event that the market's kind of concerned is going to provide movement, then that front end stays elevated. And it looks like that was justified because we literally had the CPI and it's moved the market 2%, right? Which is a 32 realized vol move on the day, a 2% move, right? So that front end being slightly elevated was justified in today's CPI movement that we got. Now, obviously, FOMC is still there. So that front end is going to continue to probably hold for FOMC. But like I say, FOMC may well be a bit of a non-event now because we know that they have to do 75, given that inflation just popped 0.6 month on month, which the market was not expecting. Okay, so this may well take some of the event risk out of FOMC because it's such a big number. Okay. Obviously, you know, their guidance about what they have to do in response to this more higher than expected inflation, they might start to then price more rate hikes in later meetings, and that clearly, you know, you could get guidance on that in the FOMC meeting. So that's what will keep that still live in terms of the movement it could create in the market. But in terms of whether or not they're going to do 75 or 50, I think it's fair to say they're going to do 75 after this number. And then finally, sort of on the equity skew side of things, skew here on S&P got to the 2nd percentile. So as we rallied to a flatter part of the skew surface, and we get that phenomenon where the skew looks very, very cheap again, right? So providing you, and a bit late now, the market's dropped 2%, but providing you with the opportunity to load up on skew at a relatively cheap level if you believe the market to roll back over again. So, you know, what I was looking at, and, you know, annoyingly, I hadn't pulled the trigger because I was anticipating that we probably have some more to go on the upside on this data point. But the trade that I didn't really want to sell calls because I thought the market could still be quite squeezy to the upside, especially if CTAs are all short again and forced to cover. So I was looking at the idea of selling like the 4,000 area, which I think will be quite sticky into the end of this month, and then buying the lower strikes, right? So buying the 37 puts in October maybe against it, or even the 3,500s in December against it as your kind of downside Vega trade where you're taking advantage of relatively low levels of skew, but you're funding it with what you think could be a sticky strike in the shorter dated 4,000 area, because the market, you don't think the market's going to melt down until after that strike goes away, basically, right? So that would be the idea there. Yeah. So the trade that I did on USO, when USO was at around 76, I bought this call spread, which was the 82.95 call spread to November. I paid $2.50 for it. And all that's really happened is we've moved from here down this curve. That's not what I wanted to do. Where is it? We've just kind of traded down there, basically, right? So I've dripped a bit. So I'm here. Obviously, if nothing happens, I'm going to decay and it's going to drift down to 0. I'm going to lose all my remainder. Got about $1.75 left in this call spread. It cost $2.50 to start with. But, you know, that's what I'm looking at. So I obviously want it to trade back higher. But for me, that's the right sort of blend of, it's short enough that it gives me some leverage, but it's long enough that it gives me some time for the move to materialize. And if we look at the realized vol, on oil, it has been pretty high and it's been chopping around, right? So you don't want to be in a situation where you're getting stopped out. And so parking your longs via call spreads allows you to not get chopped up by the noise, right? So you can see here in the oil realized vol chart, if I bring it here, the realized vol, look at the size of these moves, right? You've got down 5% on the 7th and then up 4 or 5% on the 9th. I mean, these are the type of moves that are going to stop out most positions, basically, right? So this is your reason for using optionality to play your directional view, park it a few months in the future, and then you can ignore that noise, basically, because oil is going to be noisy, yeah? So that's kind of how I looked at it, right? Which allows me to stay in the game, right? And so that's oil. If we then look at metals and what metals have been doing, as I mentioned, metals had a pretty strong rally. And that's kind of, so this is kind of the main metals that I keep an eye on and what they did on the week. Palladium was up 13, silver up about 10, platinum 7, copper 5, and gold 1. Okay, so that's kind of what we've done there. Gold, you know, a big laggard. Silver worked really well. We had obviously had our risk reversals on to protect our silver longs. And then we took that off because silver just got beaten up and it looked oversold. So that worked like a bit of a dream. You know, with silver a little bit higher, if we get back to the top of the range, then I'll probably consider re-entering the risk reversals and just doing the same trade again, right? And just kind of keep doing it that way and use those risk reversals to protect any drawdowns and then monetize them when it comes off, if it comes off, right? So I quite like that as a fairly systematic way to play it, okay? And then that same thing applies in copper. I've got some longer term positions in copper, but if copper does rally to the top of the Bollinger Band range, and I feel like, you know, I want to protect the short term tactical view, then again, risk reversal will be where I am looking on that front, okay? Because the volatility is still pretty elevated in copper. We could bring that up here. You can see the screening is saying sell calls. The vol, you know, it's not massively high, but it's not massively cheap either. It's paying for itself in terms of vol carry. So it's probably not going to collapse imminently. But just in general, when it's at around 30 vol, you know, you're less inclined to want to just buy it outright, which is why a risk reversal would be preferable. If you're going to buy some puts, you kind of want to fund them with calls because you want to keep that Vega risk down and keep that premium cost down when things are trading at 30 vol. Okay, thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.